Good morning, everyone. It's February 5th, and it's a Wednesday, and this month is going by very fast. Let's get into international news. Let's start with China. So far, we have 20,000 cases of the coronavirus known, and we have about 400 deaths. China has put in $53 billion into the market and is promising to put another $173 billion into the financial market to keep the liquidity up in light of the coronavirus, not to mess with their economy, not to slow things down. I'm not sure about the 173 billion, but the 53 billion has already gone in from what I understand. So this is very, very, very positive. And it looks like they're trying to do everything possible to limit the exposure of this virus. So let's talk about volatility and earnings. I'll kind of talk about both at the same time. So far, 50% of the S&P 500 has released earnings. 50%, give or take about 244 stocks. I'm not going to nitpick about the number. The EPS is a hair better than expected. Revenue's about 2.3% better than expected. I wouldn't really make too much out of this, and I'll tell you why. Because that EPS and that revenue has been beaten down via expectations to such a level where it's a miracle that we're not showing numbers better than that. So I wouldn't really focus too much on that. So, but here is something important. 71% of all stocks in the S&P 500 has beaten earnings per share. 67% have beaten revenue. And the highlights have been in the tech sector, including Microsoft, Intel, and Apple. Now, I want to show you something. The market is really strong right now. It's near all-time highs. Here, let me show you the S&P. Notice it's moving near the resistance level again, and it looks like it's going to open up a little higher. I believe the market is going to stagnate here, and I think we're going to stay around here, but we're going to remain choppy, and I'll explain to you why. This is the weekly NASDAQ 100 percentage of stocks trading above the 200-day moving average. And I showed this to you right before the market had a cooling off period, right after it was announced that coronavirus is going international. And yes, there's been 10 deaths in America, including New York City. That's not happiness in my eyes right now. That's a lot of concern. So this coronavirus could potentially have legs, okay? This is the momentum levels. And again, I wanted to show you this because we're near crucial momentum levels. And why? This is why I believe the S&P is going to kind of drift around here, maybe make slightly higher high, sucker a bunch of guys in and gals in at these levels, and then move back down. The percentage of stocks trading above the 200-day moving average in the NASDAQ, the top 100 NASDAQ stocks, including Microsoft, Intel, Apple, Amazon, all those, Facebook, you name it, all those big cap tech stocks are in here, NVIDIA. We've reached a momentum level. This is a 5-year chart. This is a weekly chart. Look at what happened back in January 18 when we reached above 85% momentum level. Market sold off deeply, and it happened again right here, and the market sold off, and now it's reaching for that high again, and I think it's going to cool off because once it reaches for that level, it's very hard for the market to sustain that level of momentum, especially with us being in the middle of earnings, coronavirus, and VIX volatility not being at 12 anymore, but at 15. Now, 15 is not a crazy level. That's a neutral level. It's not near 20. And I'm amazed. I'm actually amazed that we didn't go up to 20, which means markets are extremely complacent. All right. If this happened, if this coronavirus, this impeachment, all this drama that we're seeing right now, Iran, if all of this happened 2-3 years ago, that VIX would have been at 40. I mean, look at the volatility in the past. Boom, 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 boom. Look at this. We can't even get to 20 if we've had some of the worst things happen. And again, fear in the market causes volatility to go higher. So I think it's going to kind of drift around here. And I do believe that 2020 we will see more volatility because volatility is mean reverting. And I believe it's going to get to these levels right here because the markets have been too complacent. And again, we've had too many stocks in the NASDAQ 100 reach for the 200-day moving average and reach. We've had 85. Imagine you have an index of 100 stocks and 85 of them are bullish. That's a lot of pressure on funds to keep accumulating. Because remember, funds have to keep putting money into these institutional money, not retail traders. Institutional money has to keep putting money into these stocks. And after a while, it's like, what's left? They've been propped up so much, and then the market sells off. So notice every time we come to these levels, market sells off. Every time we come to these levels, market sells off. And we're there right now. Bonds, as I predicted, we're going lower. We're going lower with bonds, and interest rates will probably go higher, especially after the Fed said we're going to cut off quantitative easing in April, which means they're going to stop putting money into the bond market in April. So, virus, China, things are getting a little better. Looks like things are getting a little under control. Volatility is a little lower. S&P 500, expect more volatility and range-bound trading action. Bond market and gold, weakness taking us back to the base. This is a ETF. This is a TLT. It's an ETF, exchange traded fund that tracks the long bond. So if you're trading the 10-year futures contract or the 30-year bond, you'd want to look at this. This is very important because this is going to move side to side with it. And right now it looks like we went as high as we could, and I'm surprised we didn't go higher, but notice we didn't take out the all-time high because interest rates are not going lower. As a matter of fact, if economy improves and sustains itself and GDP is at 2.1%, it looks like we can go further. But again, I'm really concerned about these momentum levels right here. And let me just give you a quick, let's look at the index itself. And it's set to open higher this morning. Let's look at the RSI. I like the RSI. Notice I use the 10-day, not the standard 14-day, and I don't use 80 and 20. I use 70 and 30 and 10 period. So keep that in mind. Look at the overbought levels right here. I mean, we are so overbought. It's ridiculous. I mean, look at this. Every time we are overbought, we sell off. Am I expecting a major sell-off? No, but I am expecting a cool-off in tech. It's about time, especially with all of these earnings on the table. And that means we can expect choppiness and more volatility. And you know what choppiness and more volatility means? Income traders can make money. That's the best market for income traders. You want sideways market with high volatility. So get this. Rob Booker, he recently revealed a strategy that allows you to cash in every Monday morning. Automatic payday. Every Monday, pow, you get paid. Who doesn't love that, right? I mean, it's the best stuff, really, especially in the market where you've got congestion, all right? So it's a way to make thousands of dollars in income every week. And I mean that, every week, consistently. Now, access to this program has been closed. It's done. Membership is done. But Rob has agreed to let anyone click below to sign a petition to get the details to start making money. So if you want to try to get Rob to reopen the program, follow the link below, sign the petition. Hopefully he'll do it. Do it now. Again, sideways trading action, volatility is a perfect recipe for income trades, and Rob's program is killing it. Hope that helps. Talk to you guys soon. Have a great week.